Hello everyone. Today we're going to talk about the Whole Foods case in 2014. So what happened? In May of 2014, Whole Foods reported $0.38 per share in the quarterly earnings report, and the company share price fell 19% to $38.93. The U.S. grocery industry is a low-growth industry as a result of a fierce competition with low margins. The natural grocers are stores that have grown rapidly over the past 2 decades despite their higher prices. These stores have an EBITDA between 7 and 9%, like we can see here, compared to the 4% of the conventional grocers. No, we can see here, this is the line of Whole Foods market, and this is the line of the conventional grocers. Well, what else? The Whole Foods maintain a position as the market leader for the natural and organic industry. However, when the large stores like Walmart and Kroger realize the opportunity that they could have in this industry, they launch organic offerings at much lower price than similar products and natural grocers. Analysts believe that Whole Foods' biggest challenge was its reputation for high prices. For example, Whole Foods charged $2.29 for a pound of organic apple, compared to $1.99 at the Produce, a conventional store. The recent collapse of the Whole Foods stock price had caught the team flat-footed. The report from the past month recommended to investors that Whole Foods stock was a buy and worth $60 per share, based on ongoing gains to expect revenue growth and EBITDA margin in this coming year. Some people think that the natural and organic market was become saturated as more companies offer organic products at a lower cost. This competition will soon affect wholesale margin and the market share, causing same store sales decrease. Like we can see here, Whole Food market, we can see that the line of the average sales growth is decreasing or slow. However, the company wants to offer much more than a low price and seeks to compete by offering quality products and innovating the consumer experience in the store. Like we can see here, to grow, the company has been improving and opening same stores, and to compete in the market against low prices, they bet on differentiating themselves through their quality products and in-store experience. But is this the recipe for success?
They're extremely price conscious, which means they look for fair prices and expect promotions. Inside this industry, there is a niche segment called natural and organic food niche. It has had a sustainable growth of over 20% since 1990. Its sales has been growing up to 40% in 2012, and its margin too. It is composed by health-conscious consumers that always look for high-quality products, and its prices are higher than common food. Its competitors are not only other companies from natural and organic food niche, they also compete with conventional grocers and supercenters and wholesalers. As we can see in the sales, there is a huge difference because of the variety of products they offer. And well, then we have the EBITDA, the overall financial performance, the market capital of equity that measures the company value, the total debt rate for financing, and the beta. If it is less than 0.5, it means the company is less riskier than the market. If it's equal to 1, it means that it's the same risk than the market, and if it's equal to 2, it means that it is twice riskier than the market. The current market position of this company, it is that it's the leader of this segment, and it's remembered as top of mind. It is in a rapidly growing market with high growth rates, attractive margins, even if there is a downward pressure in some of its prices, which means that even if they are trying to take them down, they are going to keep their attractive margins as their current prices are really high. Their differentiation strategy is based on high quality products. Is it sustainable? Well, as we can see, we have some ratios that helps to define it. Some of them are the return on capital, which is related with the profitability and potential value creation. Then we have the EBITDA, that it's operating profit as a percentage of its revenue. And then we have the current ratio, that if it is more than 1, it's a desirable situation to be in. Then we have the current asset turnover, which means that the higher it is, the more efficient the company is generating revenues from these assets. Then we have the EPS, which is the dollar of net income that has been earned by each share of common stock. And finally, we have the sales growth that helps to see the demand of the company's product.
Regarding operations performance, we can see that Whole Foods wasn't growing as the average of their category, which is natural and organic. And this is because they are the current market leaders and they cannot grow as fast as their competitors. But which is more important is that they are increasing their EBITDA margins. And this is because of their operational strategy that aims to set higher prices based on quality and innovation products. But as we can see here, their strategic growth assumptions are stores growth and sales growth, maintaining and even increasing slightly the EBITDA margin. But we've seen the information about their competitors, and they are setting competitive prices, which I think it's not a good idea to Whole Foods and to set higher prices or maintain their EBITDA margin. And as we can see here, they aren't planning to leverage or take leverage of financial positions. So it should be a good idea for them to take financial leverage and reach more efficiency and a higher growth.
Well, now I'm going to talk about the Deutsche Bank forecast. We are not agree with the financial assumptions that the bank did. Well, I did some adjustments in the sales growth. I take the last 3 years percentages and I do a sum product formula in Excel with the data in the exhibit 4 with a 50% for the recent year, that is the 2013, then 30% for the 2012 and 20% for the 2011. All these values added must be 1 or 100%. With this formula, I obtained the 2014 forecast, sales, and the same formula for the next year. I also did the same with the store growth statistics in the exhibit 6. I take the last 3 years and give a percentage of 50% for the recent year, then 30% for the 2012 and 20% for 2011. With this data, I obtained the forecast store growth for the next years. We'll also get an average of the tax rate and put it in the forecast tax rate. With all this data, I obtained my new financial assumptions that are showing here in red. We decided to invest in this company because the share price value of the company have been increasing in the last years. The natural and organic share of industry in USA is growing. The company has no debts, but it is still increasing their market share. If the company take no on debts, can increase even more. The company have a lower beta. It indicates that it's a less risky company than their competitors. The sales of the company is still increasing in the recent years. The return of capitals of the company is attractive to new investors because investors will have more return on their investment. Finally, there is a growing trend to take care of your health and eat healthy and organic food, which is why the company has great potential.
Finally, we have conclusions and recommendations. The first conclusion: Whole Foods EBITDA margin is almost 2 basis points higher than Walmart's, but its sales are less than 3% of the wholesaler incomes. The recommendation is to stay focused on quality and innovation to keep the growth instead of just looking for sales increase. Despite the difference between sales and stores growth, the ROA and ROE have kept growing faster each year. The recommendation is to open only strategic stores that can secure the same revenue than the others. And finally, the strategy of being a premium brand has allowed Whole Foods to keep its prices higher than its competitors and keep growing. Try to continuously improve its service to generate the value for the clients and compensate even more the price. Thanks.